Hi, this is Brandon Bischoff with Canterbury Investment Management, bringing you this week's Canterbury Market Update for the week of October the 7th, 2019. And so looking at the S&P 500, we are still in market state 2, which is one of those 5 bullish market states. Again, the characteristics of market state 2 are long-term positive, volatility is positive, and short-term supply and demand indicators are negative. If we look at the Canterbury Volatility Index, which is our volatility reading, it currently measures CDI 74. And so for the last few weekly updates, we've kind of discussed the possibility of seeing some outlier days, which is exactly what happened last week. The week on the market or on the S&P 500 actually ended relatively flat. It was down like 0.3%, but there was a lot of emotion to get to that point. We actually saw a day of minus 1.2%, a day of minus 1.8%, and Friday was an up day of 1.42%. And there's a couple of reasons for why this happened, and we talked about them in prior weekly updates. Number one, the market had been approaching, overhead resistance, and it kind of bounced off that resistance. It was, then it was kind of sitting on its lower support level. And number two, we talked about in last week's update that short-term volatility was at an extreme low. Anything less than CDI 45 is considered to be extreme low in volatility, and it was sitting at CDI 40. And at extreme lows, outlier days are likely to occur. We don't know when they're going to occur, we just know that they're more likely. This is because as volatility gets squeezed down, it's like the squeezing down of a spring. Eventually you're going to see a pop, which is exactly what occurred last week. And so while last week's outliers only caused our Canterbury Volatility Index to go from CDI 69 to CDI 74, which isn't a big jump, the outliers were enough to bring our short-term volatility readings out of those extreme low territories. So short-term Canterbury Volatility Index jumped from CDI 40 to CDI 84 and kind of relieved some of that pent-up pressure we've been talking about. And so last week we also talked about the concept of support and resistance on the markets. And as a reminder, support and resistance lines are where supply and demand shift. So at support points, demand's going to take over and cause a rally. And at overhead resistance, supply is going to take over and kind of cause the market to fall a little bit. And so if we look at a chart of this, we can see the highest resistance line, which should be drawn with a thick pen, is at about 30.20 on the S&P 500. We then see a support line at 29.40 and a second support line at 28.40. And so when we were doing this weekly update at this time last week, we were kind of sitting right at the 29.40 support line. Volatility is at its extreme low. We then saw the spike in volatility on the short term. And so point A occurs. So we see a breakdown of support, which we had talked about as being a possibility. Well, then something interesting happened at point B. We actually saw the market open down and trail down 1.2% and kind of head towards that lower support line at 28.40, but it actually rallied to end the day up 0.8%. And then at point C, we actually saw an additional rally to kind of head back towards that support line at 29.40, which had previously broken. And now I'm going to say kind of the same thing we said last week. At this point, one of two things could happen. That 29.40 that was support could either behave as resistance and the market could bounce off that line and sort of head downward, or the market could continue heading upward, sort of treating that 29.40 line as kind of a non-event. Basically there was a trading anomaly at points A and B. So only time will tell what could happen there, but again, some of that pent-up pressure was relieved in the form of those outlier days. So moving on to the portfolio thermostat, we currently have a portfolio state which is bullish, a volatility of CDI 33, and a benefit of diversification of 55%. And so despite, kind of all the erratic movement last week on the markets, the portfolio thermostat was able to maintain stability. And this is because of its higher benefit of diversification. And so if the markets would have like lower volatility and, kind of be in a clear upward bull market, we would expect this benefit of diversification number to be around 25 to 35%. But because the markets have that possibility of having more outlier days because volatility is extremely low and trending between support and resistance lines, we do want to keep that number a little bit higher. And that way when we do experience those outlier days like we did last week, the portfolio is able to maintain stability and kind of treat them as non-events. And so every position within an adaptive portfolio strategy, like the Canterbury Portfolio Thermostat, has a purpose. So the portfolio thermostat currently holds a combination of long equity securities that are exhibiting bullish characteristics and are highly rated on a risk-adjusted basis. but also has a few inverse positions. So things like the Russell 2000 that aren't performing well, the thermostat might hold a position in the inverse of that. And this is to help stabilize the portfolio for when those outlier days happen and increase that benefit of diversification reading. So bottom line, short-term volatility kind of got extremely low. It caused a spike. It caused the market to break that support line and trend downward. And we're now sitting back at that same line. So that line's either going to be treated as overhead resistance now, or it's going to kind of break right through and treat that, last week's event as kind of an anomaly. But regardless, the portfolio thermostat is, efficient right now. It has an efficiency score of 90, which is in the efficient zone. It has a high benefit of diversification to kind of handle outlier days, and it has low volatility, which is, again, a bullish characteristic. And that brings us to the end of this week's update. I hope you have a great week.